Private market firms have been absolutely hammered over the last week or so. Bloomberg, Ares, KKR, we've all seen the moves. Massive moves lower, down by 10, 20% over the past 5 or 6 months. Now we hear from the management teams. And I want to talk about that right now with Paul Goldberg of Bloomberg Intelligence. Paul, welcome to the program, sir. We understand how the stocks have moved. Can you walk us through what the management teams are saying about the underlying business?
Good morning, Jonathan. They're still a little bit early. Blackstone actually reported, you just had a clip of Jonathan Gray. They actually reported last week, so they didn't really talk much about this subject at a call. The rest of the calls are actually starting this morning. Ares reported earlier this morning. KKR literally just crossed the wires. Ares made a disclosure that software is about 6% of their assets, total assets, less than 9% of their credit assets. They're the largest credit, one of the largest credit managers. So they don't see the particular risk there. They have been investing heavily because it's a very profitable and well cash flow business. So it's good for them in terms of the alignment with the investment portfolios. But they also always invest with this sort of a mode. So what Jonathan Gray was just saying about the low-level software versus highly specialized software, this is usually what they go after, something that has data or a network embedded into those software programs. And if they're lending, it's usually the senior and secured loans. So those are safer loans. They're more comfortable with those investments.
Paul, this all makes a lot of sense. Why are stock investors not buying it? You've seen all of these stocks absolutely hammered over the past year, over the past 6 months. KKR coming out just now reporting that they have total operating earnings that exceeded expectations, and yet you see this ongoing route. What will it take for investors to be convinced?
I think more transparency. Private equity, private credit, they inherently private. They don't disclose enough information, so the investors can't watch the valuations and things like that day to day. So anything that comes up as a risk always batters into the stock. So if you go back 3 months, everybody was worrying about overinvestment in AI. And these managers are very heavily invested in the infrastructure, so they were getting hurt there. Meanwhile, you see the asset inflows, organic growth in double digits. You see fees and fee-related earnings growing in solid double digits. M&A and IPO market is opening up, so more realizations, more fees related to those realizations coming to the managers. So the environment is actually somewhat better.
And Paul, what you're seeing is a little bit of disclosure. We heard from Ares earlier this morning that they have about 9% of their private credit portfolio currently in software-related stocks, 6% of their overall assets. I do wonder whether any of this skepticism among broader investors will crimp the ability of some of these private credit managers to invest and continue to finance some of these ambitious projects by the hyperscalers.
I really don't think so, because they do have the infrastructure, and especially when you talk to largest managers like Ares, KKR, or Blackstone, they're the guys who can do multi-billion-dollar checks. The smaller managers cannot, and the public markets often cannot offer the structure that these managers are. So I believe that they can actually provide something unique for that market, longer-term structures, asset-backed kind of financing that you don't typically get from a public market.
Hey, Paul, good to hear from you. Paul Goldberg there of Bloomberg Intelligence on some of these moves we're seeing from some of these names. Bloomberg's down 19% year to date. KKR's down by almost as much. These are 20% moves after they were already hammered through much of last year as well.